the one that I'm going to share with you, your exercise here. The exercise, okay, stop sharing that one, exercise this one. Okay, back to this one. Oh, not this one. Okay, the other one. Okay, we have this one, isn't it? The exercise on the financial instruments. Yes, this one. You have here. Exercise or the Kamaros? No, with okay, you have the exercise with you now. Okay, the one that you have. Okay, so we're going to discuss this one on the exercise of your financial instruments. Okay, we have two questions here. The first question is on a reader graph. Okay, a reader graph that we have here is use silver. We're going to use a silver here to manufacture a handcraft product. So we're going to manufacture the handcraft product. Okay, so we're going to look at here. Main concerns here is because of the rising in the price of the silver. So because when there is an increase in the price of the silver, we're going to reduce its profit margin. So we're going to enter into a future contract. So we're going to enter the future contracts here is to protect from the increase of the price of the silver. Okay. So just want to find for the pens. Okay, dragon. Okay, so we're going to protect from the increase in the price of the silver. So you're going to enter a future contract. I don't know what happened. Okay, we're going to enter a future contract to hedge for the price of the silver. Okay, on 1st of January, Reader Class enter into a future contract to purchase of 5,000 crowns of the silver at the price of 120. Going to buy here the forward contract here, the future contract price here is 120 per gram. Yeah. Okay, the future contract is designated as a cash flow hedge. Okay, cash flow hedge of the anticipated silver price. Anticipated for the silver purchase. So the future contract will be expired on 1st of May. So this is what you have for the price of the silver. Okay, so we're going to start here for 1st of January. So 1st of January is when you sign the contract. Okay, so you have here your future contract here is initial recognition date. So your initial recognition date is on 1st of January. And then on 31st March here is there is another date that you have here. So during this date you have a price of 120. So the spot price during that day is 120. It is the same as your future contract, which is also priced as 120. So means that during this time there is no initial investment, no initial outlay or no initial investment. Okay, on 31st March the price of the silver was increased by 125. So if there is an increase because you said that you want to buy at the price of the 20, when there is an increase in the price, so means that you're going to have an increase by 5 here. So increase by 5, the difference between the two figures, assuming that you're going to have a gains here. Okay, and then on 1st of May, the price from 125 now reduced to 123. So when there is a reducing in the value here, you're going to have the reducing in the value here is 3. So you're going to have a loss if you compare between these two figures here. 3, sorry, not 3, 2. Okay, the number here is 2. Okay, said that on the 1st of May 2017, Rida purchased 5,000 grams of silver at the price of 123. Okay, bought at that price and then make a settlement of future contract. Okay, and then the financial year end for the company here is on 31st March. So this is your reporting date. Okay, so and then the other ones you have your 1st of May here is your settlement date. So you need to prepare 3 journal entry at the 3 different dates that you have here. One is on the 1st of January at the initial recognition date, and then on 31st March, okay, when there is an increase in the value, and then the other one is on 1st of May. So when you have the reducing in value, so you need to prepare that journal entry. Okay, for that journal entry, we start with the first one. Okay, the first one at the date when you sign the agreement on 1st of January. On 1st of January, okay, there is no journal entry. Said that when there is no journal entry, read as a no entry necessary. So on 1st of January, since at the date when you sign the contract, during the date when you sign the contracts here, okay, since there is no initial outlay, when there is no initial outlay, means that there is no journal entry because you don't make any payment. So just put it here as a no entry necessary, no entry necessary, and then you only need to provide a memo. So memo saying that you enter the contract to purchase 5,000 grams of silver at the price of 120. So you just write a memo. So that is what you have. Okay. And then what we have here, the next one is on the, okay, so proceed. Okay. So we're going to look at the first on the initial recognition date on 1st of January. There is no journal entry. Okay, just put it there. Okay, and then the next journal entry that you need to prepare here is at the reporting date. Okay, at the reporting date, the price has been increased by 5. So when there is an increase in the price here, means that you're going to have a profit that you're going to have here. Okay, the profit that we have here is 5 ringgit, increase in the price, time with 5,000. Okay, time with 5,000. So you're going to have here is 25,000. So that 25,000 here will be your journal entry on 31st March. Okay, on 31st March, your journal entries here, since there is an increase in the price, so your future contracts here, you're going to have a gain. So you're going to debit. Okay, so in this case, you're going to debit your future contract. Okay, and then credit your future contract, and then credit your cash flow H reserve. Okay, OCI, SOCI at the amount of 25,000. Okay, any questions that you have for that one? Okay, you prepare the journal entry for the next one on 1st of May. What will be your journal entry on 1st of May? Any of you? Yeah, you already prepared the answer for that one. Can you just provide the answer? What is the account that you're going to debit here? And then what the account going to credit now? Okay, any of you? We have a few. We have about 37 today. Okay, you're going to debit cash. Why you want to debit cash here? The first thing you need to look at the changes in the value first. Okay, the changes in the value that you have here is a 2 here. Okay, 2. Okay, now we're going to prepare the journal entry on 1st of May. Okay, 1st of May here, the value has been reduced. The value have been reduced. So what you're going to have here? Okay, for 1st of May, we're going to account for this one. What contract that you have there? Cannot see that one. What is the thing that you have in? What be your debit side? What is your credit side? You're going to debit your, okay, on this date, you're going to debit your, because you have a loss here, so you're going to debit a cash flow H reserve of others comprehensive income, which is the amount here is 10, okay, like the one that your friend put there, 10, and then credit your future contracts, yeah, future contract cost 10, yeah, okay. Okay, and then on that day also you put, okay, this is what you have. The first thing, you need to account for the changes in the price, and then after that, on the 1st of May, you also purchase a 5,000 grams of silver at the price of 123 and make the settlements of future contract. So this one is to record for the changes in value. The next one is to record for purchase. Okay, what will be a record for a purchase here? And then the last one, record for the settlements. Any of you? Okay, once prepared for the purchase, okay, and then you're going to debit. When you purchase, you're going to debit a silver inventory. Yeah, put the word inventory there because you are buying the silver. That silver is for your inventory. And then credit cash 615. 615 here is okay, 615 here is from that 123, 123 times with 5,000. So you're going to debit silver inventory 615 and then credit cash 615 here, cash. Okay, that one is to record for the purchase. And then the next journal entries here is to record for the settlements of a future contract. What will be the next journal entry to record for the settlements of future contract? This one is the purchase of the silver. And then you need also prepare the settlements here. You already answer the first part, the purchase. What about the settlements? The last one, the last journal entry for that date. So we have three journal entry. The first one to record for the changes in the value. And then the second one is to record for the price purchase of the silver. And then the third one is to make a settlement. Okay, for the settlements here, you're going to debit cash, like the one that your friends prepared that, debit cash, and then credit a future contract. Because you want to settle means that you want to sell your future contract. Since your future contract has a debit balance, okay, the debit balance here that you have here is 15. Where you get this one is 15. So you look at the future contract. For the future contract, we start at 25 and then there is a reducing in value by 10. So you have a balance of another 15. This 15 we're going to close here. Once you are going to close means that you still have a debit balance of 15. So the debit balance here, you're going to debit cash and then credit your future contract of 15. Yeah. Okay, done for that part. Yeah. Okay. And then the last one, the next, if the things that you have for the next one. Okay, the next one is said that determine the effect of the hedging activity on the net cash flow. What will be the effect on the net cash flow? Okay, any of you? Any ideas here? You look at the effect to your cash. Okay, your cash here. If you look at your journal entry, the cash that you have here, the cash you have, the first cash that you have here is a negative 615. Negative 615 here is from your purchase of inventory. Yeah? This one is from your inventory purchase, you have negative. And then the other ones you have positive 15. Positive 15 here is from the sales of your future contract. So the difference that you have here, the effect to your net cash here is only 600,000. So this is the answer for the effect of your net cash flow. So the effect here is negative 600 because that negative 600 here is the same amount if you enter the contract at the price of 120. Okay, this 120 times with 5,000. So okay, the cash that involved here is only 600. If you don't enter the contract, the amount that you need to pay here is a 615. Since you have a future contract, you only have to pay 600. Okay. And then we look at the next one. Okay, so any question for the first parts? Okay, so all of you already know how to answer this one because your answer here is okay. This right, that one. Okay, we look at for the second part, for the B parts. Okay, for the B parts that you have here. Okay, the reader craft, for sell the silver craft item and the total cost of the craft item including the silver inventory purchased on May 2017 is 800. Okay. Okay, now the process the silver become a craft items and then the silver inventory we are using the silver inventory that purchased on May 2017. Okay, the cost become 800 and then we managed to sell that craft on 1st of July at the price of 1 million. So you sold sell that one using the inventory that you bought on the 1st of when you bought the one on March here. Okay, the one that you bought here in March, okay, you're able to sell that one. Okay, January, sorry, you bought that one on January, and then you're able to sell that one in July. Okay, process that one and then able to sell that one in July. Okay, so you purchased that one on May. Okay, the contract was on March, so you purchased in May. Okay, you process that one. Okay, in May purchase. Okay, purchase the silver. Okay, and then process it. Okay, process the silver, become a craft items, and then after that you sold that one on 1st of July. Okay, sold that one on 1st of July. Okay, so you managed to sell that one. Now it become a craft items, and then sell that one at the price of 1 million. Yeah? So you need to prepare the journal entry. The first journal entry here is to record for the sales. Okay, and then the second journal entry here is to record for the COGS. And then the third one is reclassifications of your others comprehensive income. Okay, you prepare the journal entry for the first one. What will be your journal entry for the first one? Okay, for the sales. Okay, what will be your journal entry for the sales here? Any of you? Still waiting for your answers here. Okay, you're going to debit what? For the sales. Okay, you're going to debit cash and then credit sales revenue, sales revenue of 1 million. Okay, the next one for COGS. Okay, for COGS, what will be your journal entries here? I'm going to debit your COGS here. The next one, COGS. Any of you for the COGS? Debit COGS. Okay, debit your COGS. Debit your COGS. And then credit silver inventory. It's not silver inventory anymore because we already processed that silver become a craft inventory. Not silver, craft inventory, because you already processed that silver into craft items. So craft items. So now it become your new inventory, not a silver. Silver is already processed, become a craft items. Okay, and then the third journal entry, you just change the silver into craft inventory. Yeah? Amirah just change that one. Yeah? Okay, the last journal entry to record a classifications here. We said that when we sold your inventory, the one that you reprocess, okay, we need to reclassify. We need to transfer from others comprehensive income, transfer it to income statement. Okay, what will be the last journal entry for the reclassifications here? We call this one as a reclassification. Means that we need to transfer from others comprehensive income to the income statement. What will be here? Okay, any of you? Okay, what is the balance that you have in others comprehensive accumulated others comprehensive income? How much you have the balance here in others comprehensive income? Okay, 15. So 15 here, so means that you're going to debit. What's the things that you're going to debit here? You want to close this account, and the one that you have in others comprehensive income, we want to close the account because this has a credit balance here. Still have a credit balance here. Okay, you start with 25 for your cash flow hedge. Okay, cash flow hedge. Okay, this one is start with 25 and then you reduce another 10, so means that you have a balance of another 15. So balance of another 15. So the balance that you have here is a balance in the credit side. So means that when you want to close this one, you need to debit your cash flow hedge reserve 15. Okay, OCI 15, and then credit your COGS of 15. Okay, so this is what called as a reclassification. We need to look at what is the balance of your cash flow hedge reserve, okay, which is the one that in your others comprehensive income. And then the amount here, once we sold, we only recognize or reclassifications from others comprehensive income to income segment. One, you sold the inventory that you already processed. Yeah? So once you sold, you transfer that one. So look at the balance here. The balance that we have here is 15. So 15, one that you need to consider is a 15. So you're going to debit the cash flow hedge reserve, others comprehensive income 15, and then credit your COGS of 15. Okay, so any questions for questions 1, part A? Any of you have a questions for the questions 1, part A? Any questions? Any questions? Okay. So, any questions before we proceed to the next one? No questions. So we proceed to the next one. Okay, the next questions that we have here is a little bit tricky. And we keep that question for a while. This question here is a little bit tricky. So before you answer the questions that we have here, okay, we need to know a few things that need to amend to this questions here. Okay, the first thing that you need to amend here, okay, we look at questions B, Arida Berhad. Okay, try to move this one a little bit here. Okay, we'll try to look at the Arida Berhads here. Okay, for Arida here, so Arida purchase and put options. Yeah, they purchase a put option. So the put options here is an options to sell. When you purchase the put options here, is an option to sell. Okay, put option, option to sell. Okay, so they're going to protect. Okay, going to protect for the share price. Okay, going to protect for the share price that you have and some space. Can we, okay, let me look at this one. Okay, oh, wait. Okay, so I'm going to protect again the price. Going to protect again the price of the shares of the Lalila Berhad. Okay, so the ordinary share on 3rd of August. Okay, protect the value of the ordinary share on 3rd of August at the 350. That 350 here is your premium. Yeah? Okay, your premiums that you bought here is at the price of 350. So if that one is a price of 350 here, for this price we have two elements, which is intrinsic value, and then the other ones we have a time value. Okay, the put option is for 2000 shares and the strike price here is 20 ringgit. So the strike price for the put options here is 20 ringgit per share. And then the options will be expired at 1st of January 2018. So in this case, we don't know what is the market price of Lalila. So we assume that, okay, now we're going to assume, we assume that, okay, we assume that market price of shares on this date, on 3rd of August here, 3rd of August, we assume that the market price of the share is equal to the strike price, which is 20 ringgit. So if you have this information, then you can do this motions here. So we assume that the market price of the share at the at the 3rd of August here will be 20 ringgit. Okay, so we have two here in terms of the market price of the share. So the first one, market price of the share is 20 ringgit. Now the price reduced to 18. So you can just reducing by 2. And then after that, the price increased to 21. So increase by 3. Yeah? Okay, this is the time value of the options. Okay, the time value of the option, we start with, since that when at the date when you sign when you purchase the put options, the premium here is 350, and then during that date we assume that since the intrinsic value here is a market value minus strike price. Okay, minus the strike price. So we assume that the market value here is 20 and then the strike price is also 20. So the intrinsic value here equals to 0. So your intrinsic value equal to 0, it means that your time value here is equals to 350. So you're going to have here 350. Okay. So if you look at here on 30th of September, the price was reduced, at the time value was reduced by hundreds, hundreds. And then you have here in the 29th of December, the price reduced another 50. This one is for time value of put options. Yeah? So this one is the intrinsic value that we have here. Okay, so this is the things that we have here. You purchase a put option to protect. So to protect here, we don't know whether they enter the hedging or not. So we assume that now we are in the process of doing the hedging activity, because to protect here, like the one that you have in example 5 about DEF, yeah? Like the one that now you can refer to example 5. Yeah? Okay, example 5 for DEF. So we use options here to protect. Okay, we use options to protect the value of the shares. Yeah? Okay. Okay. To protect. So like the one that you have in example 5. Yeah. So we're going to prepare the journal entries here. Based on example 5, we assume that we protect here by doing the hedging activity. So we're going to have two items here. The first item, you're going to have hedge item. Okay, the hedge items here is your investment in Lalila. Lalila investments. Investment in Lalila. Okay, and then your hedge instruments here is your options, put options. Okay, we have two items here because we assume that to protect, like the one that you have here for the one that you have in example DEF. So they use the word to protect, so we assume that this one we are using the hedging accounting. We bought the options here to protect or to hedge against the changes in the price of Lalila shares. Yeah? Okay, so you prepare the journal entries, okay, at the date when you investment in the put options. Okay, prepare the journal entry for that one. When you bought the put options, okay, on this date, when you bought the put options, you're going to, okay, again, okay, when at the date when you bought the put options, you're going to debit your put options, okay, put options, and then credit your cash. So the amount that you paid for the put options here is 350. 350. This is what we have here to record for the put options. Okay, now we only have the put options on that 3rd of August. Okay, now we look at on 30th of September. So 30th of September here, the price of your investment reduced. We have here from 20 reduced to 18. So means that you have a loss here. Okay, so you're going to debits here. So you're going to prepare two journal entry because we have two items here. One is for the H item and then the other one is for the H instruments here. Okay, what will be your journal entry to record the loss in your H items here? Okay, two journal entry here. One for the H item. Okay, and then the other one is for H instruments. What will be your journal entry on for the H items? Since there is a reducing in value here. Going to debit. What about this one? Any of you? Chua? You answer this one, Chua? For the H items here? The 3rd August here is journal entry that we have here is only for the put options here. Okay, what about this one? Any of you? Any of you? Okay, and then you're going to debit. Amira said debit the loss in the H item. Okay, in each item, and then credit your investments. Investment in Lalila. Oh, my pencil. How much you have for this one? The difference that you have here is for thousands. Okay, loss in the H items here, you're going to put a word P and L here. Okay, P and L here. I'm going to put that one. Okay, the first journal entries here is to record for the H item. So the H item, you're going to have a loss. Okay, so debit loss in the H items in the P and Ls, and then credit investment in Lalila. Okay. Then for the put options, okay, the put options, you need to look at the time value here. What be the H instruments that the next one that you have for the H instrument? Okay, the second journal entry for the H instrument. Okay, what will be the journal entry for the H instruments here? Okay, what will be that one? Look at the put options here. The value of put options has been reduced. So you're going to debit. Okay, you're going to debit put options here. You're going to debit your loss in the H instruments. Okay, loss in H instrument, and then credit your put options. Okay, going to credit your put option. Okay, the amount here will be hundreds. That one will be a journal entry on 30th of September. So you're going to have two journal entry. Okay, and then on 29th of December, we have for that 29th of December. Okay, 29th of December, what you have here? Now Arida settle the options before expired and settle the option before expired. Okay, before that you look at the value of your shares. There is an increase here, so account for the H item first. H item. What will be the journal entry for the H item? And then the other one, H instruments. And then the third one is a settlement. So now I'm going to look at the settlements. Okay, we're going to prepare the journal entries here. And then the next one we're going to have for settlements. Okay, what will be your journal entries here? Okay, for the H items. H items, what will be the one that you have here? Okay, for H item first. For 29, the 29, the price become 21. So increased by 3. What will be your journal entry for that one? Okay, any of you, please. Okay, you're going to debit your investment in Lalila, sorry. Investment in Lalila. Yeah, and then credit gain on each items. Yeah? Gain on each items. The one that you have here is 6,000. Okay. And what you have for H instrument? Okay, for H instruments, what you have here? H instrument, there is a reducing in value of your options. Okay, we're going to have again the same journal entry. We're going to have a loss on H instrument. Okay, and then credit your put options. How much you have here? The loss that you have here from the reducing in the time value that you have here. Okay, any of you? 50, yeah? So you're going to have here 50. Okay, now I want to make a settlement. Okay, want to make a settlement here. Okay, how are we going to make a settlement here? Okay, what is the balance of your puts options that you have here? If you look at the put options here, you start with 350. Okay, you have a loss of hundreds. Okay, again you have a loss of another 50. So the balance that you have here, what's the balance that you have here? Okay, okay, so the balance that we have here is still have a balance of 200. Okay, so 200 here to make a settlement here means that you need to, how we going to make a settlement for that one? Okay, how are we going to make a settlement for the put options then? What about the last journal entries that we have? Okay, what will be your settlements? How are you going to have that one? You're going to, again, for the settlements here, you have a loss here. Okay, you're going to debit the loss on each items. Each instruments, and then credit your put options. Settlements here, we're going to record as a loss here, 200 here. Okay, 200. And then loss, since you have a loss here, we don't have a cash there. Okay, so the put options here, we just debit loss here. The fact here will be a loss because you already bought that one, so you cannot debit your cash. You bought that one, so you're going to debit. Cannot debit your cash, you just debit a loss. Okay, debit a loss on settlements. Loss on settlements of put options. Okay, that is what we have for the settlements. Debit loss on each instruments, and then credit your put options. Loss on settlements of the each instruments. Okay, and then that is what you have when you settle for the options before the expiry dates. Okay. Any questions that you have for this one? So you make a settlements before the expiry dates. Okay. So if you look at here, how much the effect to your income statements here? Okay, the question doesn't mention that whether you sell the shares or not. Okay, assuming that because the question is not complete here. So if you assume that you sell the shares, okay, if you assume that you sell the shares, okay, how much the value of shares that you're going to receive for this one? What will be the value that you receive here? Okay, you're going to have loss here. If you make a settlement, let's say you sell the shares, what will be the amount that you're going to sell here? You're going to sell at the price of 21. So 21 times with 2,000. How much you have for that one? Okay, if you sell, okay, can we put it here? Okay, okay, for total, okay. So can we put this one? Okay, now let's say you sell that one. Can I find a space here? I can have a space here. Maybe we need to have some space here. Okay, let's say you sell. Okay, let's say you sell. Okay, when you sell here, and you sell the shares. Okay, then when you sell here, you sell at the price of 21 ringgit. So 21 times 2,000. So you are going to have here 42. Okay, look at the amount of your investments. Okay, your investment, let's say you start at the beginning, your value of your investment is at 20 ringgit. So 20 times with 20 times with 2000, so you're going to have here 40, yeah? 40 at the beginnings. Okay, you have 40,000 there. Okay, 40,000, and then look at your journal entry. So journal entry, at the first journal entry, you have a loss, yeah? Loss in the investment, you have a loss of 4,000 here. Okay, and then you have an increase by 6,000. Okay, you have an increase by 6,000, so total amount of your investments here is 46,000, the debit side. And then look at your credit side here. The credit side, you have 4,000 here. So 4,000, then the balance here means that 42. Okay, so to sell that one at this price, so you're going to debit your, because we need to know what is the balance here, whether you have a gain or you have a loss here. Okay, so in this case, the balance of your investments here is 42. So you're going to credit investment 42. Okay, since the price here is also 21 ringgit, time with 2000 is also 42. So you just debit cash of 42. Yeah. So means that there is no gain or loss from the hedging activities. Okay, you only have a loss here in terms of your put option. Okay, in terms of your income statement, when you look at your income statement, what will be the effect on your income statements here? Okay. Okay, so you're going to have your catch also 42. Okay, look at the effect to your income statement. The catch income statements. Okay, because this one is a fair value hedging. So the fair value hedging here, any changes here will be transferred to your income statements. Okay, the first one for your income statement, the one that you have here is on 30th of September. Okay, on 30th of September, you have the first loss that you have here is 4,000. 4,000, and then again on the same time for the time value, you have a loss of 100. Okay, then on 29th of December, you have a gain from the investment, the H items. You have 6,000 here, and then at the same time, you also have a loss from the time value, which is 50. Okay, so what do you have here? 6,000, and then any other gains that you have here other than that, and then you have on that 29 any other gains that you have or loss that relate to your any other loss that you have here. Say we have done for that one gains already. Okay, loss 50, and then the other loss that you have here is loss for the settlement. So another 200 that we have here is a loss on settlements. Okay. Again, we need to have this one. Okay, we're going to have loss on settlements, another 200. So now what is the difference that the effect to your income statements here? Effect to your income statements. If you look at here, so you have here 6,000. This one is 4150, isn't it? 4350. Okay, what is the difference that you have here is you have what 50 here. This one you're going to have 1650. The effect to your income statement. So your income statement has the effect of 1650. Okay. Any questions that you have for this one? So anything that you have difference here. Okay, we assume that this one is using the hedging. We use the options here to hedge. So hedge all the options. Okay. So we have a loss. The first one we have a loss of 4,000. Just want to look at the effect to your income statements. The first one you have a loss 4,000, and then a loss another 100. And then on 29 December you have a gains of 600, and then you have a loss of 50. And then settlement for the put options, you have a loss of 20. Okay, that is what you have, a loss of 200. So and 200. So the effect to your income segments, in terms of your income segment, you have an increase by 1650 from this journal entries. So the put options now you need to close, so the put option should have a zero balance. Okay, so you have a loss here, loss of 1650, yeah, the effect to your income statements. Yeah. Okay, why you have a loss here? Because your options that you want to buy the shares here, okay, you want to buy the share you want to sell the share at the price of 20, but the price of shares here is 21, so you are selling below than the market value, so you're going to have a loss here, loss in terms of your option. But in terms of your incomes here, because you have increase in the intrinsic value, okay, when there is an increase in the intrinsic value, both will affect your income segment. So the increase in intrinsic value is more than the reducing in your time value. So you still have a gain in this case. Yeah? Okay. So any question for this one? But the questions too here is the B parts here, some of information is missing there. So we just only assume the sum of the information, like the one that we assume here is the market price of the shares. Yeah? We only assume that one. And then on the 29, okay, the 29 is said that the ARIDA only settle for the options. When they settle the options, we don't know whether it sell the shares or not. Okay, if you settle the options here, the journal entries here is only up to this one, up to the settlements here. Okay, the journal entry is only up to this one, up to the settlements here. The journal entry is up to that point only, because we don't know whether we sell that one or not. Okay, because the options that we have here, okay, maybe you don't need to exercise your options here, because the option price here is only 20, but the market price here is more than 20. So it means that if you exercise your options here, you're going to have a loss. Yeah? So maybe you don't need to sell your shares, yeah? Because the option price is lower than the market price. You said that this one is out of money, so you don't have to exercise your options. So the options here, like the options, you just close the account. You just close the account. So we don't going to have this one. We don't need to exercise this to sell the shares, because if you refer to the option price, you can sell the shares only at the price of 21. But if you want to sell it, the market price here is if you want to sell based on the option, the price here is only 20, but the market value is 21. So that's why you don't need to exercise your option, because once you exercise your option, you need to sell at the price of 20. Yeah. So this one, when you sell here, they assume that we don't exercise the options. We not exercise the option. Okay, why we don't exercise it? Because the market value is higher than the option price. Okay, so option price, then we said that we're going to have a loss, then we're going to have it out of money. So this one is without, you can sell at the price of 21 if, okay, okay, if you sell this one without an option. If you sell with the options, okay, with the put option, you only can sell at the price of 20. So you're going to debit cash. Let's say you are using the option. So you are using, when you sell the share using the option, the cash that you're going to receive here is only 40,000, which is 20 ringgit times with 2,000. And then the investments that you need to credit here is 42,000. Okay, 42,000, and then you're going to have a loss on investments, loss on shares, loss on the disposal of investment, another 2,000. Yeah? So you're going to have a loss of another 2,000. This way, if you exercise the option. So once you exercise the option, you need to sell at the option price, which is 20 ringgit. So 20 ringgit, the amount of cash that you can receive here is 40,000. So it's not wise to exercise the option because the market price here is 21. If you exercise the option, you're going to have a loss of another 2,000. Okay, and then if we continue this income statements here, okay, if you look at here, up to this one, okay, up to this one, we have a gains here. Okay, up to this one, we have a gains of 1650. And then if we have exercised the option, we have a loss of another 2,000. So means that you have a loss of 350, which is equal to the value of your options. Okay, so this is what we have. So better for you not to exercise your options. Like the option, you just settle the options there. Okay, settle means that you just close the option without selling the shares at the option price. Okay. So any questions that you have for question 2? Okay, why don't we follow example 3? Example 3 here is, if you look at the example 3, that example 3 is example as a derivative. That one is only as a derivative. So if you read the question, the example 3. Okay, refer back to example 3. Okay, the example 3 here, if you look at here, you purchase a call options. Okay, it gives right to purchase. Okay, you have a call option. The example 3 here is a call options. Okay, during the call options here, you have a right to buy the shares. Okay, so you have the right to buy. This one is a put. So you cannot follow the, okay, example 3 is a different from what you have for this exercise. Okay, we just going to explain what is example 3 about. Okay, we need some space here, maybe. Okay, so can we just switch down here? Maybe we need some space. Okay, we put it here. Okay, so what is the difference between example 3? Okay. Okay, example 3. Okay, for example 3, you have a call option. Call option here is a options to buy. Okay, options to buy. Okay, options to buy. In this time, we don't have the H item. Okay, we don't have the H item because we don't have the shares yet. We don't buy, not yet buy. Okay, we not yet buy the shares, so we don't have the H item, so we cannot enter, or we don't have the H relationship. Okay, and then in our ARIDA's question, in ARIDA, here we have a put option. So put options here, we already have shares. Okay, already have shares. Okay, your shares here is your H item. So when you bought an options, when you bought the options become H instruments. So that's why we need to follow example 4. Difference here, example 3 here, because we don't have the H items yet, because we only want to buy. Okay, want to buy the shares. Want to buy the share. We're not yet buying the share, so we don't have the H item. So just the options here, the call options. Okay, please be careful, because the call options here is the options to buy. We don't buy the shares yet, so it means that we don't have the H item. The put options here, we already have the shares. Okay, we want to protect against the reducing in the price of the shares. Okay, so we have the H item. So when you bought the put option will be used as the H instrument. So we're going to have the H relationship. So we are going to prepare the answer for ARIDA like the one that you have for example 5. Is it okay, Bear? Should I answer? Okay, so clear about that one. So different things. The example 3 is call option to buy. Example 4 is a put option. Your example 5 It's like the Aridas here is a put option, options to buy, sorry, option to sell. So you already have the H item and then you bought the H instrument. But for example 3, call option, you don't have the H item, you only have the instrument, the financial instrument. So you cannot enter the hedging relationships. Yeah. Okay, clear about that one. Okay. Okay. So, well, the rest okay. So, can we proceed to the next questions? We proceed to the next questions. This question also confusing for the B parts. Or the B parts is confusing. Okay, for the mascara here, the mascara is not much different from what is the name of the company? Not Arida. What is the name of the company that we have here? For Rida Craft. For Rida Craft. Okay, now we're going to look at the for the mascara. Okay, the things is not much different from the Rida Craft. Okay, so we're going to have here same thing. Mascara use goes in the manufacturing and specialized craft jewelry and product, and then they need to buy to purchase 500 ounce of the goods in October 2018, and then for the jewelry, so they have to process that goods to become a jewelry. Okay, so however, if the price of gold increase, then the cost will be increased, and they're going to reduce the profit margin. Yeah? Okay, and then on 1st of April 2018, EKB enter into a gold future contract. Okay, you enter a future contract to hedge for the risk of the increase in the gold price, and then designated a future contract as a cash flow hedge of the anticipated gold purchase. Okay, the notional amount of the contract is 500 ounce, and the terms of the contract. Sorry. Okay, and the term of the contract give AKB the right and obligation to purchase a gold price of 5250. So the contract price here is 5250. Okay, going to have that one. Okay, the contract price that you have here is at this amount, 5250. That will be your contract price. The price will be good until the contract expires on 31st October 2018. So this is what you have for the price of the. Okay, please change this one, not the call option. It's supposed to be a future contract. So, okay, this is what you have. Okay, on 1st of April, the price here is 5250. Okay, the forward contract also at the price of 5250. You want to buy 52500. So 52550, yeah, 5250. Okay, you're going to buy, saying that you're going to purchase a price of gold at this price. Okay, on 1st of April, you enter the contract. So if you look at here, the contract price is the same value as the price of goal. So you're going to have here, that means that there is no initial outlay, okay, on the contract date. So this is your contract date, initial recognition date. Okay, and then on 30th of June here, okay, 30th of June here is the reporting date. So the price has been increased. So the amount that increased here you have here is 50. So when the price is increased by 50, means that you're going to have a gain, because the price of the goods has been increased. So you're going to have a gain here. Okay, and then on the 30th of September, okay, 30th of September, again, the price was increased. The price was increased by 100. So, okay, increase again 100. So, again, you're going to have a gain. So, on 10th of October, EKB purchased 500 ounce gold. So, now purchase a 500 ounce of gold at a price of 5,400 per ounce at this price. Okay, and then sell the jewelry containing gold purchase on 20 of December at the price of 6 million. And then the cost of inventory here will be the cost of goods, the cost of goods here is 3.5. And then EKB settle the future contract. So this is the mountain. Okay, we're going to look at the first part. Later on, we will look at the second part here. Okay, we just want to prepare the journal entry for the first part. Okay, the first part here is at the initial recognition date. So initial recognition date is when the price you enter the forward contract. The price of the forward contract is 5250, which is the same as the price of your gold, which is 5250. Yeah? So means that there is no initial outlay. So means that there is no journal entry, no entry necessary. You only need to provide a memo. Yeah? On 1st of April, no journal entry. You just provide a memo. Okay, for that one. Okay, memo. What is the thing that you need to write in a memo? Just write that on 1st of April 2018, enter a forward contract to purchase a gold at a price of gold inventory at the price of 5250. Just write a memo on that one. Yeah? Okay, on 30th of June, okay, 30th of June, the price was increased by 50. Yeah? Okay, price of increase by 50, so you're going to have a gain here. So when you're going to have a gain, you're going to debit a future contract and then credit your cash flow each reserve. Yeah? Okay, and okay, others comprehensive income. So this 50, the amount here, this 50 need to time with 5. How much you have here? 500,000, isn't it? Okay, 500 ounce. Okay, then you're going to have here will be 20. Okay, that is a journal entry on 30th of June. Okay, what will be a journal entry on 30th of September? Okay, now the price increased by another 100. So, okay, another 100, isn't it? Hundreds. We have here from, okay, hundreds. What will be a journal entries here? On 30th of June. Any of you? 30th of June? I'm still waiting for you. Journal entry on 30th of June. Because you close your account on that 30th of June. Yeah? What will be a journal entry on 30th of June? Any of you? 30th of June? There? Any of you? Oh, there. Few of your friends here. Any of you? Lim? Any of you? Journal entry on 30th of September. Are you still there? Any of you? Journal entry on 30th of September. Any of you? Okay, future contract. And then what will be the next one? Future contract. And then cash flow. Future reserve. OCI at 50. Yeah? Okay, 50. Okay, so that is what you have. Okay, future contract, because there is an increase in the value, so the debit future contract and then credit your cash flow each reserve. Okay, so that is what we have on 30th of September. Okay, what happened then? Okay, 30th of September. Any other date that we have? Okay, on 10th of October. Okay, assuming that you settle the future contracts here. Okay, what happened on 10th of October? Okay, on 10th of October, you also, what is the thing that happened on 10th of October? You purchase. Okay, few things that happened on 10th October. The first one, purchase. Okay, the second one, okay, purchase 500 ounce, and then you settles the contract, purchase and then settles the future contract. Okay, what you have for that one? Journal entry on October when you purchase. Okay, what will be the journal entries here when you purchase here? Okay, what will be the journal entry? Any of you when you purchase the inventory? And then the other one is settle. Okay, Ridwan, can you prepare for the settle? Okay. Lynn, can you go for the, okay, you're going to debit gold inventory. Okay, gold inventory and then credit cash at 2.7 million. Okay, 2.7 because you bought that one at the price of 400 times with 500. Yeah? Okay, and then the other journal entry for the settlements of future contract. Okay, what will be the debit cash? Okay, you're going to debit cash. Okay, the amount of your future contracts here will be 75. Yeah, but you get that 75, 25 from the journal entry on 30th of June. Okay, 30th of June, and then plus another 50 from journal entry on 30th of September. So altogether you have 75. Done, yeah? And then on December, so December you need to prepare 3 journal entry. Okay, prepare the first one, the sales, and then the next one you have the COGS, and then the third one is a reclassification. Reclassification means that you're going to transfer from others comprehensive income to your income statement. Okay. So can you prepare any of you? The first journal entry is to record the sales. Okay, can we put it here? Okay, record the sales here. Okay, you're going to debit cash, yes, cash, and then sales revenue. The amount here is 6 million. Okay, and then COGS, the next one. For COGS, COGS. Okay, COGS 3.5, and then credit your, okay, gold inventory. Is it goals? Because your the goals is already processed become a finished good. Your goods inventory that you're going to credit say is not goals anymore. It's supposed to be a jewelry. Because you already processed the gold become a jewelry. Okay. And then the reclassifications here. Reclassifications. You want to transfer from your others comprehensive income to your income statement. Okay, for the inventory change, instead of gold here, it's become a jewelry because we already processed that gold, become a jewelry. Lim, okay, yeah? Okay. And then reclassifications, you want to transfer from others comprehensive income to your income statements. Okay, what will be your journal entry for this one? Okay, for this one. A reclassification, the last one. You need to look at what is the balance of your others comprehensive income. So you're going to debit, can I put it here? Okay, you're going to debit cash flow, H reserve, OCI. Okay, and then credit your COGS, which is the amount that you have here is 75. Okay, so that is the last journal entry that we have. We transfer from others comprehensive income to the income statement. Okay, the last part for these questions. Prepare the statements of financial positions. Okay, what do you have here? Okay, what is journal entry that you have up to 30 of June? Okay, up to 30 of June, your journal entry that you have here is only future contract and then cash flow H. Okay, OCI, yeah? Okay. So you're going to have here your future contract here is your asset, and then your cash flow here is your equity. So in the segments of financial position, you provide full names of the statements. I just want to show the items here. Okay, for your items here, you're going to have two items only. Under current asset, you're going to have a future contract. Okay, and then under equity, you're going to have the cash flow hedge reserve, OCR. How much this one? 25. Okay. So that is what we have. Okay, up to this time, up to 30th of June here, there is no effect to income statement, because the effect to income statement here is when you sold your inventory. So inventory, then you're going to have impact to your income statement. If you not yet sold your inventory, your cash flow hedge reserve remain in your others comprehensive income. Yeah? Okay, so any question with this exercise? I mean the question to EKB. Mas Kiara Berhad. Do you have any questions here? Any question for Mas Kiara here? Any of you have a questions? Okay. Any questions? Any questions that you have before I proceed to the second one, the second part, which is this one, yeah? Or move to this one. Any questions that you have for the A and B for the mascara? Any questions? Okay, so understand that one. Okay, so we try to look at this one. Okay, if you look at this one, this is a statement without a question, but we just want to do that one based on the we want to calculate the forward price only. We don't know what is the question for this one, because if you look at here, A and B part is related with the cash flow hedging. So we don't know what is the question for this one, but we just want to try to answer this one using the we assume that we want to find the price only, the forward price. Okay, so we try to look at this one, the one that you have here, this one. Yeah? Okay, so maybe we need to have this space. Okay, so okay, some more space. I'm using the space later. Okay, so you have here. Okay, there is no question, there is only a statement here, so we try to answer this one. Maybe the question, okay, we just guess for this one. Maybe the question asks you to calculate the forward price only, because it said that you enter the forward contract. Okay, when you enter the forward contract to purchase of forward contract here, okay, to purchase of 500,000 shares of Dana Jaya Berhad. Okay, in an anticipation that the price of DJB going to be rise for the next 6 months. The prevailing price of DJB on the dates of the contract here is RM5 per shares. Okay, so this is information that you have. The maturity dates here will be on 1st of April 2019, and then the risk free here is 6%, and then the dividends yield that you have here is 3%, 3% of dividend yield. Any other information that we have? Okay, and then the price. Okay, the price on 31st December here is RM5.10. So we don't know what is the question required. So we just try to calculate. That maybe we just try to calculate the forward price only. Okay, we start with the forward price. Okay, remember that the forward price, the formula for the forward price is the spot price on that date. So the forward price that we have here is start from 1st of October. Okay, time with 1 plus R and then minus Y time power by T. Okay, so on 1st of October, the spot price that you have here is RM5. So you have 5 here. Time with, okay, we have 5 here. 1 plus R. R here is 0.06, the returns. And then Y that you have here is a 0.03. Yeah? Okay. Yeah, and then your T here. T here is from October until the maturity date. October until, this one is on October until 1st of April. So 1st of April. So October until April you have 6 months. Yeah? So 6 months here is 6 divided by 12. Okay, so this one is 1/2. October, November, December, January, February, March. So you have 6 months. So what will be the price here? Just calculate for me this price here. What will be the price here? You just calculate that one. Okay, 5.07. Yeah. Okay. The next one on 31st December. Okay. Again, you need to calculate the forward price. So price during that time is 5 ringgit and 10. Again, the same thing. 1 plus 0.06 minus 0.03. Now, from 31st December until April, 1st of April, you only have 3 months. So 3 divided by 12 here. What you have for the price for that one? Any of you? What is the price that you have for that one? Okay, 5.14. Okay, 5.14. Okay, so you have here 5.14. Okay, it seems that there is an increase in the value. So increase in the value here means that we're going to have a gain. So how much the increase that we have here is 0.07, isn't it? The increase in the value. So you need to time value, present value that amount. Remember that, to present value that amount. Okay, how we're going to do that one? To find the gains that we have here. Now we're going to refer to example 1. Yeah? So the example 1 that we have here, we need to have a present value. So the difference that we have here is 0.07. We want to have a present value to find the gain. So in this case, the present value of gains, yeah? Here the present value of gain. The gains that you have here, the difference between that two figure is 0.07. Okay, divide by 1 plus r, because this one to find the present value, 1 plus r here is 0.06. Okay, and then during that time the periods that you have here is 4 months. Okay, 1 over 4. Okay, what do you have for this one, for a present value? What is the figure for this one? Okay, what do you have for that one? Okay, what you have for this one? 0.07 divided by 1 plus. This one is to find a present value. And then after that, we need to time with, okay, we need to time with 500 cents. This one is to find the present value first. And then after that, we need to time with 500. For this one, how much you have for this figure? Any of you? Okay, 0.69. So 0.69069. Okay, time with this figure. How much you have for this one? Should have done, okay, 34,500, yeah? Okay, let's do 34,500. So this 34,500 here is your gain, yeah? It's a gain because there is an increase in the value, so that will be a gain. So you're going to debit once you have a gain. This is like the one that you have for example 1, yeah? Okay, you're going to debit your, okay, forward contract, okay, forward contract, and then credit your gain on forward contract. Yeah? Okay, the amount here will be 34,500. Okay, so that is what you have for the because you don't know what is the questions required yet, requirements for the question, so we just calculate. Okay, we just calculate the price, the forward price on 1st of October, and also the forward price on 31st December. So it seems that there is an increase in the forward price. So increase in the forward price means that you're going to have a gain. So the gains here need to time with the number of shares. Okay, number of shares that you have here is 500. So you're going to debit a forward gains of 34,500 and then credit the gains on forward contract 34,500. So this one is you can refer to example 1. Yeah? So I think that we are done with this one. So any questions that you have? Okay, for the next class, I want to discuss with you Dr. Skamaru notes, example from Dr. Skamaru note. Please read that one because you need to know that example because you have the CC2. The CC2 is more or less on how to prepare the CC2 is like the one that you have for the example that you have in Dr. Kamaru's note. So we're going to discuss Dr. Kamaru's note for the next class, the examples only and not the explanation. We just want to discuss on the example. So please read on that notes. Yeah? Okay, so for those who still have questions, okay, I'm still here. Okay, and then if you want to scan for the attendance, you can scan for the attendance, or you want to discuss anything. Any of you are not yet scanned for the attendance, just put it here in the chat box there. The on are going to add that one manually because I still want to use this one, this exercise if your friend have a questions on that one. Okay, so any questions that you have? If there is no questions, you can leave the meetings now. But for those who still have questions, you can ask the questions regarding the exercise or anything. But for the next class, please make sure that you read Dr. Kamaru's note. Okay, Nora Shikin, okay? Okay. Any questions that you have there?
Hi, Doctor.
Okay.
I want to ask about the group assignment.
Okay. Your group assignment on what? Oh, assignment. Sorry. Assignment, yes. Okay.
The question requires us to select one bank
Okay.
to do the assignment. So we can just randomly select one bank. No need to mention in the group. Because I scared we clash with another group bank.
Group, you means group, our group in the same group J or different group?
Yeah, the same group J.
So same group J, you are using the same company. How many bank actually that we have? Is it enough for all group? We have only 7 groups. I think that 7 groups we have. Bank in
they got
in the
10 bank.
10 banks, so enough for everybody, isn't it?
Yes.
I mean enough for every groups.
Yes.
So can you choose that one different from another groups?
So we need to list in the WhatsApp group,
Yes.
like what bank we choose.
Like what you done last time. Just list down so that your price is not similar with the one that you already choose.
Okay, thank you, Doctor.
Okay, any other questions? Okay, Daniel, Audrey, and Nora Shikin. Okay. Other questions that you have? Any other questions that you have regarding your exercise here? Or any other questions? No questions, huh? Okay, the questions 2 on the forward contract and also the question for Arida is question is not complete yet, so you cannot do that one actually without complete information. We just guess on the answer on that one only. Okay. We assume that what is the question, so we only assume that. Okay. So any other questions that you have? Want to wait for another 2 minutes? Now I want to end the meetings. Okay, if you have any questions.
Doctor, I want to ask the question number 1A. Just now, Doctor mentioned the effect on the net cash flows.
Wait. Question 1A. This one, huh?
Yeah, yeah. Yeah.
Okay.
The effect on the net cash flows. Yeah, I a bit confused because just now I missed the explanation from
Okay.
doctor about the 600,000.
Oh, okay.
Yeah,
Okay.
yeah.
The effect of to the net cash flow here, you just look at what is the effect, journal entry that relate with the cash flow. If you look at your journal entry that you have a cash flow here, the first one is when you purchase a silver, isn't it? So when you purchase the silver here, the amount that you have here is negative 165. 615. So negative 615 here is from the purchase of the inventory. Okay, purchase of inventory. The net effect here, we only need to focus on the cash effect. Okay, the cash effect that we have here. Okay, so we're going to look at the effect on cash. Okay, the cash effect. So the cash effect, the first journal entry that you have here is a purchase. Okay, the purchase. So the purchase here, you have a cash here is negative 615. Okay, and then the second journal entry here is about the settlements of forward contracts. Settlement of future contract. The settlement of future contract, when you settle a future contract, you receive cash. Okay, you receive cash of another 15. So the effect here going to have here is a negative 600. So negative 600 here is the effect to your cash flow, the effect to your net cash flow. Okay, if you don't have the future contract, you need to pay 615. But with a future contract, you only pay at 600. Okay, is it okay, bye? This
Okay, clear.
okay.
Okay, thank you, doctor.
Okay. Other questions that you have? Any of you have questions? No questions, sir. So I'm going to end the meeting. So for the next class, please read Dr. Kamaro's notes. Okay.